It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Email Ferenc, F-E-R-E-N-C, at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. There's been a lot of discussion recently about the affordability crisis. There's two primary reasons why the prices of just about everything seem too high to people. We printed nearly 40% more dollars in 2 years during COVID. This was the largest peacetime money expansion in modern U.S. history. As a direct result, houses, food, insurance, borrowing costs all reset higher. It's basic supply and demand. More dollars chasing goods and services are going to increase the cost of those. Mortgage rates that were once near historic lows have now reset to about 7% and are likely to remain there for the foreseeable future. This increase in money supply and the jump in everyday goods and services are affecting lower income and the younger generations the most. At the same time that we increased our money supply by nearly 40%, we also brought in a large number of people into our country, both legally and illegally. For most working Americans, the cards have been stacked against them, and this is how the system actually works. Companies can hire someone from a long list of government-preferred categories and receive a direct federal tax credit of $1,200 to $9,600 per person. This is a credit that's dollar for dollar against the employer's tax bill. It's cheaper for companies to hire employees under preferred categories that include SNAP recipients, that's food stamps, other government welfare recipients, SSI, ex-felons, certain veterans, the long-term unemployed, vocational rehab referrals, and designated community residents. These are the same categories are the ones that are tracked on state benefit applications. The vast majority of these people are on one or more forms of welfare. Now, a young American who finished school, stayed out of trouble, never collected benefits, and just simply wants an entry-level or mid-level job does not trigger any of these credits. The employer receives no tax break for hiring that person. The system is rigged against them. The system is designed to reward the person that carries the government-preferred flag. This is government interference. Now, I'm not saying that some of these categories should not get some preferential treatment. Veterans, for example, are one category that I believe do deserve preferential treatment. But many of these other categories are there due to political reasons. It's the government interference that skews the job market. It's not about the individual employees, it's about incentives. When the tax code and the benefit system both tilt towards certain categories, Americans who follow the traditional path become the more expensive option to hire. And this is how a law-abiding citizen becomes a competitive disadvantage in the labor market. I have a number of my clients who their children or grandchildren who have had these experiences. Some of my younger clients have also. And I saw this post that I thought was really powerful. It was written from a recent STEM graduate who finished at the top of his class. I did everything that was asked of me: high grades, strong projects, internships. This was the promise for the few with the ability to complete this coursework that I believed would open doors. It has not. I've been through interview after interview with no offers. At the same time, many of the foreign students I studied alongside already had jobs waiting for them before they even graduated. I am still sending out applications and receiving rejection notices or silence. He wrote this letter to the government pointing out that they created the HB1 program with the promise that it would fill temporary skill gaps and bring the best talent to America. And this is not what is happening. What I'm seeing is a system that often prefers workers who arrive with sponsorship already arranged, while American graduates who trained alongside them are left competing for fewer and fewer open seats. The opportunities for people like me keep declining. This harm is quiet and very personal. It lands on students who did the work, still can't find a place in their profession that they prepared for. I was promised something that did not come true. And one of my clients, they were discussing their youngest son who had graduated with honors in data science less than a year ago. He worked his way through school, applied for everything, got a STEM degree, graduated near top of his class that was packed with international students who gets years of work authorization through OPT. Then they flood the HB1 pipeline, and all this extra supply hits the entry-level data roles that their son was applying for. As she pointed out, we did everything we were told as parents to help our son pay for college. Their son did everything asked of him: strong grades, hard work. He had skin in the game. And the reward? He currently has a restaurant job because he can't find an opening in his career field. She was pissed. As she pointed out, their family had invested years and large sums of money into helping their son obtain a STEM degree and the promise of a better economic future. And that promise is not happening. And as she even pointed out, this doesn't affect just individuals and their families, but all taxpayers, because we pay for university, federal grants, contracts. And as she put it, I'm sick of taxpayers, especially those that have been following the rules, getting the shaft. As she put it, I'm mad as hell, and you should be too, because our tax dollars should not be funding this mess. And I find it ironic, the argument that younger people have gotten lazy has tied in roughly at the same time that companies were able to replace their American hires with F1 visa holders, which are exempt from FICA taxes for the first 5 years in the U.S. This started, by the way, in 2008. And the State Department has a program to replace American kids looking for seasonal jobs with foreign workers. They sweeten it with a 15% federal tax discount that businesses can take if they hire foreign workers. It's called a J-1 visa, and they call it a cultural exchange. In reality, it takes away seasonal work primarily for high school and college students. And the government has placed their thumb so much on the scales towards foreign workers. To give you an idea, if an entry-level employee was paid $31,500, would save the company almost 10% in taxes. The U.S. citizen, the taxpayer, the one that's doing it right, following the rules, is at a competitive disadvantage. And when corporations get to import cheap foreign labor so they can skip competing for American workers at real market wages, that's not free market capitalism. That's a government-backed wage suppression scheme dressed up as a labor shortage. Free markets require fair competition among American citizens, not open border cheat codes for multinationals. As of mid-2026, it's estimated 7 to 8 million American workers are explicitly unemployed and actively searching for work. If we have millions of American citizens looking for work and cannot obtain it, why are we still allowing about 1 million foreign work visas into this country each year? This is a massive problem that needs to be stopped, or it will have societal and structural impacts into our economy. If you take away the opportunity for the American dream from many of the younger generation, this will cause long-term societal challenges. Many people are wondering why so many young people are turning to more radical political solutions like socialism, for example. Well, this is the reason. They don't see any hope. If you take away the hope of a better future from a large chunk of the younger generation, don't be surprised if you see chaotic results in society, politics, economics. This could have massive impacts for all of us, and most of them are not good. If you want to protect yourself from uncertainty, potential market downsides, potential chaos in the future, contact me at yourpersonalbank.com. This is the golden era of fixed assets. Seeing some of the best rates and returns I've seen in my 27-plus year career. Index products protect the downside while still allowing you to obtain tremendous upside potential gains. The problems I've been discussing are not just about work visas. There's a whole category of other visas out there that exacerbate this problem even further. I'm going to discuss those. I'm going to recommend you stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com. This is Ference, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. The affordability issue is not only about the government spending too much money, which it certainly is, during the COVID years, where the total money supply increased nearly 40% just in 2 years, allowing large numbers of people into our country, legally and otherwise. Much of the legal immigration has been taken advantage of, significant levels of fraud. Far too many work visas have been approved to allow far too many people into this country, but it expands even beyond that. There's a whole series of visas, and this system has not been updated since 1990. People come in on temporary visas like F1, J1, M1, E3, TN, R1, L1. It goes on and on. And then, thanks to recent Supreme Court decision, give birth to children, and those children automatically get U.S. citizenship. And once those children become adults, they can then sponsor their parents for green cards. And this has been going on since 1990. Now, these foreigners are not only looting American jobs and livelihoods and contributing to the increased costs of everything that we need, houses, food, clothing, etc. They've added almost 15 million anchor babies or U.S. citizens since 1990 from temporary visa holders and illegal immigrants. That's the best estimates. When these children start sponsoring their parents, the number could increase to 40 to 45 million. Now, to win a U.S. presidential election, you need about 70 million votes. These people now are already deciding council elections, mayors. We've seen that already. Look at New York City. Soon it's going to be governors, senators, and then the president. Do we want to have our elected leaders to be decided by people who have no allegiance to this country, who oftentimes absolutely hate this country and everything it stands for, and want to change it to something we do not recognize? We have to stop this visa fraud. We have to reduce dramatically the numbers of people that are coming in here legally. Thankfully, President Trump shut the border down and illegal immigration has basically stopped since he took office. But the legal immigration problem has been building since 1990 and continues almost unabated. We don't need people coming in here on visa fraud, taking away jobs from American citizens, then allowing the children to sponsor their parents. This is a recipe for disaster. And not only does the fraud happen in many cases from the people coming here, that's been well documented, with fake degrees, nepotism, all types of fraudulent schemes to get into this country and get some kind of visa and then stay here or overstay their visa and stay here illegally. But a recent analysis indicated that foreign nationals here legally took out roughly $2 billion in PPP loans, of which most was never paid back. And where did that money come from? U.S. taxpayers. In fact, that's enough money to deport almost 1 million illegals. And there were companies that were advertising H-1B visa holders can secure mortgages with no credit. Many of these mortgages today are now in default. Foreclosures are accelerating in areas where there were many H-1B visas. And the fact that a foreign national here on a supposed quote-unquote temporary work visa could obtain a 30-year mortgage, that's ridiculous. The fraud goes on. It's now been confirmed with public records that in Philadelphia, Pennsylvania alone, in the past decade, over 100,000 non-citizens received a jury summons. Now, there's only one way you can receive a jury summons. You have to be registered as a citizen to vote. And these were all non-citizens. This is just in one city, over 100,000. How many people in this country do you believe are non-citizens and are registered to vote? The number has to be in the millions. But the fraud continues. Dr. Oz just confirmed that over 96% of all personal care claims for Medicare in Pennsylvania were listed as illness unspecified. This makes them untrackable. And the average payment per beneficiary? Over $50,000 per person, which, as he stated, is far above the average. Therefore, 96% of personal care claims are illness unspecified and are highly likely to be fraudulent claims. And in recent Senate testimony, it was reported that over 9 million people, or nearly half, of Medicaid expansion enrollees likely did not qualify for the program. This costs taxpayers over $33 billion a year. As the report stated, the 9 million adults that enrolled in Obamacare's Medicaid expansion may not have met federal eligibility requirements in 2024. Have you ever noticed that we hear from the Social Security trustees, Medicare trustees, politicians, bureaucrats, Social Security, Medicare are running out of money? Yet we never hear about government welfare programs, SNAP or EBT or housing, or ever unearth any threat of running out of money. And it's been documented that over half of food stamp recipients are illegals. So why is it these programs, these welfare programs that are used significantly by non-citizens, never at a threat of running out of money? Yet the funds that citizens contribute to or qualify to receive, like Social Security, Medicare, have been constantly under threat. If you receive Social Security, Medicare, or plan to, you should be adamantly against fraud because, frankly, that's one of the biggest threats to those programs. I get this discussion all the time from folks who are retired or thinking about retiring and doing retirement income planning and have valid concerns about Social Security, Medicare. Most recent Social Security trustee report recently stated that if nothing changes by 2034, that's only 8 years from now, folks, benefits will be cut about 20%. The best thing that could happen is fraud to be reduced as much as possible. And the best way to reduce the fraud is get the people who do not qualify for these programs and should not be on them off. And the best way to get them off the program is to get them out of the country. Therefore, if you want to continue to receive Social Security at the levels you are currently receiving in the next decade, or planning to do so at some point in the future, you should be in favor of deporting anyone who does not belong here. That would include all illegals. The vast majority of them are on these government programs. And you also should be in favor of dramatic reductions of foreign visas, because the vast majority of them are also on these government programs. They're draining the funds. It's that simple. They're contributing to the affordability crisis that we all are dealing with, and especially the lower income and younger folks. Here's the reality. Life has gotten a lot more expensive. In the last 20 years, inflation has caused the cost of most things we purchase to double. The massive welfare state, mass migration, and fraud are all destroying affordability and upward mobility for younger generations. It's robbing us blind. We need to attack these issues ruthlessly, or the American dream could be lost, especially for the younger generations. You take away the hope of a better future for the younger generation, or from many of them, don't be surprised if you see them voting for radical solutions like socialism. We're seeing the beginnings of it now with the mayor of New York City. This is only the beginning unless things change. And the fastest, quickest solution to this is get rid of the extra people that do not belong. That's the best quick solution to the affordability crisis, and prevent the longer challenge, potential chaos of economic and political upheaval. In the meantime, to protect yourself, index products are one of the best tools to allow strong potential upside gains with no downside risk. It's a golden era of fixed assets, the best time in literally 40 years. If you want more information on this, contact me at yourpersonalbank.com. The S&P 500 had hit all-time high recently, and the bond market has also hit the highest levels since the Great Recession of 08-09. It's nearly impossible for both of these to continue, and one is going to break. I'm going to share some more thoughts on what will likely happen and what you can do to navigate this. So stay tuned.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com. Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. You can contact me at yourpersonalbank.com, email FERENC at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. The S&P 500 recently hit another all-time high. And if we take a step back and look at what's going on, it's kind of interesting that it's been on a tear since early 2023. January of 2023, the S&P 500 was around 3,800. Today, it's about 7,800, or basically double. So in 3.5 years, the S&P 500 has basically increased 100%. It's been a fairly straight line. We had two big dips, one in early 2025. That was the tariff scares, if you remember. And another in March of 2026. The Iran war, increased cost of oil was the main cause of that. Other than those two major time frames, it's been on a historical increase. Now, questions get asked all the time about what's likely going to happen. Frankly, no one knows. No one can predict how much, how long, how high it's going to continue. But if you step back and take a historical perspective, it's increasing at a level and rate that's unsustainable. Almost certainly a pullback will occur. Could be a significant one. The higher it goes, the more significant the pullback will likely be. We haven't seen a strong pullback that's lasted for a while, really since the 2008-09 Great Recession. So many people have forgotten what it's like for the markets to really take a severe correction. Unfortunately, when it does happen, we will likely see a lot of pain because human beings have a short attention span, short memories. Most people are paying attention to the S&P hitting new highs. That's getting all the press and all the attention. But I think the bigger story has to do with the bond market. It also is continuing to rise and increase at levels not seen since the 2008-09 Great Recession. If we use the 30-year treasury as an example, and we take a step back, the longer-term picture, the historical view, we hit all-time lows in 2020 where the 30-year treasury got as low as around 1.5%. It has been on a significant, strong incline ever since and is now above 5% levels. Primary reasons behind it are the same that I shared in the earlier segments about the affordability crisis. Not only does the printing of all those extra dollars, increasing the monetary supply by nearly 40%, COVID years, that inflation alone increases interest rates, the continued increase in debt, the federal debt means the government has to sell more bonds. Every time they spend money, print a dollar, they got to sell bonds to back that dollar. Again, basic supply and demand. Have lots of supply of bonds. What do you have to do to entice the bond buyers? You have to offer higher interest rates to get them to purchase those. The government's selling historical all-time levels of bonds, and this is why the projections going forward are to continue higher. Many are saying the next 5 to 10 years, even longer. Really, it's going to continue until the federal government, Congress, gets their spending under control, fiscal responsibility. And here's the other common misconception. Our government's not broke. They're receiving about $5 trillion a year in tax revenues, which is also all-time high records. The problem is they're spending about $7 trillion. So they're spending about $2 trillion a year more than they're receiving, and frankly, much of that is fraud. And these insane welfare programs that many non-citizens are taking advantage of. So we, the taxpayers, are getting shafted twice, one by having to pay taxes, taking away from our income, our investments, but then much of that going to pay for benefits for people that do not belong here and contributing to increased inflation, increased cost of goods, and more unaffordability. So we're getting hit with taxes on one hand and inflation on the other. Everything's getting more expensive. The two go hand in hand. And people ask me all the time, when will this bond yield, long-term bond yields, interest rate situation resolve itself? Frankly, not until Congress, again, gets their fiscal house in order and stops spending more money than they're receiving. And currently, there's no appetite for that at all. Again, if we go back and look at the bigger picture, here's a couple of reasons why I'm more interested in what's going on with the bond market than I am with the stock market. One, you got to understand the bond market is far larger than the stock market, many-fold larger. Most people are surprised by that. They don't realize how large the bond market is. And in general, what you need to understand is higher interest rate, higher bond yields are generally not good for the stock market. Why? The reason's simple. The cost of borrowing money to invest, expand businesses increases with higher interest rates. So a low interest rate environment is typically good for the stock market. A higher interest rate is typically bad for the stock market. They can deviate from each other for a while, but eventually one of them is going to come back to normal. And the thing that's driving the bond market is not changing. The spending, the debt, bonds that the federal government is selling at levels we've never seen in human history. That is going to be the driving force to continue to push the bond yields, interest rates higher and higher. In fact, that trend has started again in early 2020. If you look at a chart of the 30-year treasury, for example, all you see is it on an incline for the past 5-6 years now. Interestingly, we were in a long-term declining bond market yield since the 1980s. It was on a long-term downward trajectory, and it bottomed out, as I stated, in early 2020. Then it shifted and started going up and has been doing so ever since. The likelihood of the bond market continuing to increase is extremely high. It's the much larger market, total dollar volume, and impact on the economy. The long-term interest rates will drive the economy. It will drive interest rates. It will drive the value of stocks in the future over the long term. They both cannot continue to drive upwards. It makes no financial logical sense long term. So one's going to break. One's right and one's wrong. Which one is it going to be? My bet is on the bond market. Again, for the primary reasons of it's the much larger market and the forces driving it up are continuing to happen for the foreseeable future. What's driving the stock market up? Mostly the tech stocks, innovation, new technology. There's a lot of enthusiasm and excitement there. The bond market interest rates are being driven up by solid monetary reasons. There's no enthusiasm or excitement or hype around increasing bond yields. It's plain risk and reward. Government keeps selling more bonds. They have to keep getting these bond buyers to purchase them, so they have to keep sweetening the pot. They have to keep increasing the rate they're offering to get the buyers to buy them. And this is a train that's just is running down the tracks. It's not stopping. It's not even slowing down. Stock market is based more on sentiment, what somebody thinks is going to happen. The old fear and greed. Well, when the fear overcomes the greed, price changes. And it's just not my opinion. I'm basing this on many, many factors, economists, and what I think maybe is one of the best reasons of all. Look at what Warren Buffett is doing. I've had a number of listeners reach out to me pointing out that Berkshire Hathaway currently sits on more cash, both in total dollars and percentage-wise, in Warren Buffett's 60-plus year career. And he's been called one of the best investors in history. And if you look at his track record, you can easily see why. He moved to significant cash prior to the dot-com bubble, about a year or so prior, and the same thing with the Great Recession. He's moved to significant cash about a year or so ago this time. So when are one of these markets going to break? Because again, for them both to continue to go up like they are, next to impossible. One's going to change. One's going to change direction. And typically, when that happens, things happen slowly at first until they all of a sudden happen very quickly. Now, these increasing bond yields, likely to continue for 5 or 10 years or more even, creates risk on one hand, risk of a stock market correction, perhaps a severe one, but it also creates opportunity for those that are looking to grow their money safely while still obtaining tremendous upside gains. And that's where index products come into place. is the golden era of fixed assets. It's the brightest time seen since the 1970s. The biggest returns we've seen, the biggest upside gains, the biggest bonuses, and the best products overall I've seen in my 27-year career. In fact, I'm having more fun helping people get into tremendous financial positions without downside market risk with tremendous upside growth since I started 27 years ago. This is fun, folks. And if you want to learn more about this, contact me at yourpersonalbank.com. Stay tuned in the last segment. I'll share a few stories from some listeners and clients that I've discussed over the last week or two. I think you'll find it interesting.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com. This is Ference, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Email Ference, F-E-R-E-N-C, at yourpersonalbank.com or 866-268-4422. Yes, you will reach me. One of the meetings I had this past week from a listener I found quite interesting, enjoyable, and educational. And I think many of you will find this very interesting yourselves. So this gentleman contacted me, shared a little bit of his financial history. As he pointed out, over the last 20 years or so, he had done very well in the stock market. He had, in fact, even at one point, purchased some biotech stock that he really believed in. And literally over a weekend, the value of the stock more than doubled. As he put it, it was a leapfrog forward with his portfolio, and it was a significant amount of money. So, as I put it, tremendous weekend. He said, absolutely, it was awesome. And then more recently, a couple of years ago, he decided to get into silver. And he purchased it, told me around 30 an ounce, kept it for a year or so until it got up over 100 an ounce and decided to sell out. Great timing. So he had experienced two tremendous leaps forward in his overall portfolio in his investment career. And this had put him in a position that, as he put it, money was never going to be an issue for him going forward, which was great. But he still had some goals he wanted to accomplish. There were some charitable organizations he wanted to do some things for. And he was concerned about where the asset values are in the stock market currently. He had actually moved to CDs recently because of those concerns. Obviously, the returns on those CDs weren't all that great, but it was, as he pointed out, better than nothing. and he was looking for something until he heard my show. He'd been listening for a while. As we discussed further, I shared with him more about the index annuity products. And the one that really piqued his interest was the bonus products that are currently available. As I stated, in his case, in most states, up to age 89, in fact, we have products that'll pay up to a 26% bonus, signing bonus, actual cash, not an income rider bonus, which is not actually cash. It's an actuarial calculation. Real cash bonus, increase your account value by 26%. He got pretty excited about that because, as he pointed out, that would help him accomplish his remaining life goals when it came to his financial goals. It would be a third leapfrog forward if he could take his portfolio and jump it by 26%. His statement was he understood the upside potential growth with the caps, rates, fees we shared, strong upside growth based on the past decade plus of what this particular product had done. We can't predict the future, but certainly we can look at what it did previously and what most likely it'll do in the future. The downside, of course, was guaranteed, like all index annuity products, unless you have one of those hybrids where you have limited downside. But as we discussed further, again, this third leapfrog forward would allow him to accomplish his remaining lifetime financial goals and help with the charitable donations he wanted to make, ensure he had plenty of money to live on in retirement, even if it didn't grow. So he got excited about that. And if you think about it, his situation is not as unusual as many people think, in that oftentimes it's a jump forward. Something big happens somewhere along the way. You might get slow, steady growth, and all of a sudden something pops and it's like, boom. And he had seen this twice, again, with a biotech stock some years ago, more recently this past year or two with silver, and then now looking at the bonus with the index product. And he also liked the fact that the downside was guaranteed. So by increasing his overall portfolio by 26%, boom, right out the gate, that's a tremendous leap forward, and it can never go backwards from there. This way, he's locked it down. And this is one of the factors that I find many of my clients really appreciate. I did last week share a lot of details about index products, how they work, all these types of things. If you missed it, I encourage you to go to yourpersonalbank.com. You can listen to this or any of the previously recorded shows. Or if you want to email me, Ferenc, F-E-R-E-N-C, at yourpersonalbank.com. I'll email you last week's show because I really spent the whole show going into depth about why this is the best time in 40 plus years to look at an index annuity product, or if you have one, why you should seriously consider transferring any annuity product you own, you purchased prior to 2023. I go into depth on the reasons why, but I have gotten some questions about some of that sense. I want to clarify a little about the bonuses. A lot of people get confused or have questions about the bonuses or get sold on the bonus as the end-all be-all. Now understand, there are different types of bonuses. The ones I'm discussing are real cash bonuses. They increase your account value day one. So, for example, to keep it simple, if you deposited $100,000, your account value would be $126,000 day one. There's no other costs or fees. By the way, I don't charge any fees. I could. Most financial people, I'm sure you can appreciate, regardless of what they call themselves or what title they use, if they recommend a financial product to a client, they're going to get paid by the company that they recommended it to. And in most cases, that's in the form of a commission. That's how I get paid also. Many financial people also charge fees under management or other types of fees. I chose 26 years ago not to do that. I learned that from my mentor. And I found if you're not getting charged extra fees, that allows all your money to grow. And that's the strength and difference of these index annuity products. All your money you contribute goes to work. Plus, if you get a bonus, that additional bonus goes to work right away. It increases your account value right away. This is one of the ways where you can maximize returns on your money without downside risk because, again, they guarantee the principal. And by the way, the bonus is included in that. So if you deposited, I get this question. If you deposit $100,000 and now your account's $126,000, well, it's not going to go down below $126,000. So if you had a 10% return in a year, you're going to get credited based on the $126,000 instead of the $100,000. So that further compounds your future growth, which really turbocharges things or leapfrogs your account values. When a bonus makes sense for a client, for me, it's a lot of fun. And I've had situations where we're increasing portfolios for people by hundreds of thousands of dollars with the bonus. These companies are paying the bonuses, a signing bonus to get you to do business with them. Just like an athlete, where a team pays a signing bonus for an athlete they want to join their team. Sort of the same philosophy. Now, there is a trade-off whenever you get a large signing bonus. Obviously, there's no free lunch. The company cannot give you a large signing bonus and maximize your upside potential returns. So in most cases, they're going to curtail those returns to some degree. What I find in most cases, that your upside potential growth, your caps, your rates, your fees, whatever you, and again, I'm not a fan of caps. The myth that's out there that if you want guarantees, you got to give up strong returns, that's a myth. And most time, the reason why people don't get strong returns is because they have caps. There are many, many index products without caps, no caps at all, which means unlimited upside gains. People are surprised when they hear that because they didn't know. I'll show you dozens of products with no caps, unlimited upside potential gains, and historical great returns of anywhere from 7.5% to 15% plus average annual returns over the past decade or longer even. How do we accomplish that? By eliminating the caps, folks, and getting you in good, strong indexes that have a good, strong historical returns. But back to the point about what the trade-off. The trade-off is your upside potential gains are going to be reduced some. In most cases, again, I don't use caps. I don't recommend caps, very rarely, if ever. And we tend to limit fees to low fees or no fee products. So the difference is in the participation rates. The participation rate is the percentage of the return you get on the index. And we have participation rates anywhere from 60% to 180% in 1 year, for example. So if an index went up 10%, you would get 6 to 18% return in that particular year. This is how we've had clients get 20% plus returns in a single year even. 10, 11, 12% even average annual returns over a decade plus. It's by having unlimited upside, no caps, strong indexes, low or no fees, strong participation rates. But understand the trade-off, again, with the bonus is your participation rate is going to be a little bit less, about a third to a half of what a non-bonus product is. And what I find the difference is if you want to maximize your returns, say the next 5 or 6 years, a bonus product's going to have more money in it because it got turbocharged. It leapfrogged forward by 26% or more sometimes even. So it's got to jump forward. The non-bonus product has a higher potential upside growth rate, to anywhere from about 50 to 100% faster, higher participation rate. So it's going up each year at a higher rate, but because the bonus product got such a jump, it's way ahead, right? So it takes time to catch up. So what I find is it's about 5 years, give or take, where a non-bonus product catches up in value to the bonus product. So the question I ask all the time, and I show both options to people so you can have full understanding, full disclosure, and make a clear, educated decision. Which is more important to you? To maximize your returns in the next 5 years or less, or the next 5 years or more? Because clearly the non-bonus product that has a higher potential upside each year, has a higher participation rate, is going to grow faster than the bonus product will. And eventually, when it does catch up, let's say around year 5 or 6 or so, give or take, it's going to keep going up faster. So it'll eventually lap the bonus product. So some people will say, oh, understanding that, why would I do the bonus? Well, what if your time horizon is 5 years or less? Well, a bonus product makes sense then, doesn't it? This could be true for somebody who's maybe a little older, or the other reason bonuses often are used is because you have a penalty to get out of an existing product. As I shared in last week's show, because of these long-term bond yields, being so much higher than they were just even a few years ago, 2022 and prior, the newer index products are going to return more. It's mathematical because a company bought a bond, got the higher interest rates to get the higher returns. If you've been suffering poor performance and hoping it gets better, that's wishful thinking, because the company bought the bond once and that same rate it's going to pay the insurance company. And remember, they invest the interest off the bond. If it's a limited amount of interest, it's going to be the same amount for the next 20 or 30 years. Remember, they're buying 20 and 30-year bonds typically. If you get a new product with a higher interest rate, the bond paying the higher interest rate, they got more money to invest, more to work with. It's going to get you a higher return for the next 20 or 30 years, regardless of what the economy does or interest rates or anything else for that matter. So again, if you are suffering with poor performance, there's no reason to. It's like self-flagellation. You're just beating yourself up for no reason. And if somebody's trying to tell you it might get better in the future, that is delusional. The company only has so much money to work with because that bond that they bought in 2022 or prior is paying a low interest rate. They have a limited amount of money to work with to invest to make a return. It's not going to change, and it's not going to change for the next 20 or 30 years. Total delusional, wishful thinking. You can transfer it to a newer product with much, much better returns. Average returns on the newer products, 2023 and newer versus 2022 and older, is about 250% higher. That's because just look at the 30-year treasury. In 2022 and earlier, it was paying around 2%. It's now paying around 5%. That's a 250% increase. It's math, folks. It's not wishful thinking. And the bonus products can help you offset that penalty if you have an early surrender penalty. And I have yet to find somebody who has had a 26% penalty. In fact, most cases are much, much lower than that. So if you have a 5 or 10% penalty even, which would be a significant one, a 26% bonus puts you way ahead day one. So there's no reason to continue suffering that poor performance of that existing index annuity product. This is the best time in 40 years for fixed assets. It is the golden era. The best products I've seen in my career up through age 89 in my 26-plus year career. Contact me for more information at yourpersonalbank.com. If you want a copy or transcript of this show, email me at Ferenc, F-E-R-E-N-C, at yourpersonalbank.com. Please contact me if you have additional questions or would like to look at your situation further. Stay tuned next week to the Your Personal Bank Show for more great information. And as long as it's on our money, in God we trust.
Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states.
This is Ferenc, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.